Okay, so we're going to start on chapter 11. It's page 438 and 439 in your book. So chapter 11 is about liabilities, current liabilities, and we're going to talk about some payroll stuff as well. So just take you some good notes. But let's talk about a liability. You already know a liability is an obligation, right? Meaning a company has an obligation or a debt out there that they are required to pay at some point. Maybe a given due date, it may not be. However, with the liability, there are three factors, three things that you need to be concerned about. The first one is the liability itself is based on a past event. So what that means is you can't just gain a liability by doing nothing. You would have either had to purchase some supplies on account or purchase something, equipment or something to that nature on account for it to be a past event. And then secondly, that's what makes it a payable. That's what makes it the obligation. So that's the second factor. Third factor, for future sacrifices. What do we mean for future sacrifices? What are you sacrificing in the future for an obligation that you did in the past?
Future salary?
The money, right?
Yeah.
You got to pay it, is what that's saying. So first thing is an event has to happen for you to create a payable, which is the second factor. Third factor is for a future sacrifice, which means that you are sacrificing cash in the future because you have to pay or you are obligated to pay that liability back. So classifications of liabilities. We have current liabilities and long-term liabilities. With the current liability, all that means is that that is a liability that is going to be paid within one accounting period or year. Okay, so within 12 months. If it's a long-term liability, it's going to extend past what? Over a year or whatever is the company's operating cycle. Okay, so that could even be one day over 12 months. It doesn't matter. It will be considered long-term. This here is just an example, and I believe they give it to you in your book. It looks like Exhibit 11.2 of current liabilities, as opposed to total liabilities for some well-known companies. So Six Flags. What this means is, out of that 443 million of liabilities, only 16% of it is current liability for that company. Now, what you'll learn later on in other chapters is that that's a pretty decent percentage. Reason being is because you probably want to have way more long-term than you do current. If you have more current liabilities, that means that you are unable to pay them fast enough within 1 year. But if they're long-term, that means that you can stretch it out. You have more of a time to make a better profit. Bowl America, which I've never even heard of that company. However, they have 3.2 million in liabilities, but 54% of that is current. Columbia Sportswear, 179 million, 83% of it is current, which that's pretty bad. Apple, it's no surprise that they would have 74% in current liabilities. Apple is a very big company, so that's fine. But look at the amount of total liabilities that they have. So uncertainty. Why do we have an uncertainty of a liability? If we know we went and purchased something or whatever the case may be, what could possibly be uncertain about a liability? First thing is whom to pay. And this is in your textbook on page 439 at the bottom. Whom to pay. Why are we uncertain about who we need to pay? Let's just say they gave you an example of a notes payable, right? Generally, a notes payable can either be current or long-term. It can either be due within a year or it can be past that. But let's just deal with current notes payable. If you had a notes payable, 9 times out of 10, your uncertainty about whom to pay could be because a lot of creditors change hands and do a lot of third-party stuff. So who you thought you were going to pay is not necessarily who you owe. And it might exchange hands somewhere before you make your first payment. So now you have a totally different person that you are obligated to at that point for that liability. Uncertainty on when to pay. Why is it uncertainty when to pay? Think about it.
They don't know
Think
how much
critically.
they'll be required to settle. They might know how much the obligation is, but they don't know how much actual settlement.
Right. So in other words, a good example of that is, you know how attorneys will do services, but they'll give you a retainer, meaning pay this amount now. Right. The retainer is to hold me for my services, but I have no idea what kind of services I'm going to have to give to you in the next 6 months.
Right.
And I honestly cannot bill you until I do a service for you, even though I have that retainer. That retainer was to just secure my services. And then uncertainty in how much to pay. What does that mean? We deal with that every day in our regular life. That's it. You have no idea what a light bill will be or a gas bill will be until you receive it in the mail, right? And that's when you know how much you're obligated to pay. Good. So, known liabilities. Some of these you've heard of, some of them you have not. Accounts payable, that's one that you should have known from Financial Accounting 1, right? Even possibly sales tax payable, I think you probably heard about that in Financial 1. Unearned revenues, I'm not sure if you heard about that, but just in case you have not, unearned revenues are basically when you receive cash up front for something that you have not performed as of yet, but you plan to perform in the future. Short-term notes payable, I just talked about that. You know what a notes payable is. Payroll liabilities, those happen to be current liabilities because they only arise when you're actually paying payroll, which we'll show that later on in this chapter. And multi-period known liabilities, meaning liabilities that stretch beyond just one accounting period. So sales tax payable, they're giving you an example here. It says on August 31st, Home Depot sold materials for $6,000 that are subject to a 5% sales tax. To calculate sales tax, it was relatively easy. They took the $6,000 that the materials were sold for, multiplied that by the 0.05 or 5%, and that gave them $300 in sales tax. Now, this is just to show the sale of those materials, the amount of sales that was paid, and then the cash received from that. Unearned revenues. They gave you an example of a concert. A lot of these celebrities, they get money way up front before their concerts. Like you notice how a lot of them will sell concert tickets a year in advance. It might not be until next year. Sometimes you don't care. You pay for the ticket up front so that you can get a good seat, better price. Same situation. This particular artist, Rihanna, sells 5 million in tickets for 8 concerts. She has not performed them yet. So we have to consider it as unearned revenue. So she earned 5 million or received 5 million cash for tickets sold for her concerts. Notice when she performed one concert, then she earned 625,000. But what they're trying to show you is that 5 million divided by how many concerts? 8 concerts equals 625,000 per concert. So when she actually performs the concert, we take it out of unearned revenue, we put it into revenue. That's what this journal entry is for. The top journal entry is to show the unearned revenue total of 5 million. Every time she does a concert, you would record this journal entry at the bottom, taking that 625,000 out of the unearned revenue account by debiting and crediting ticket revenue. Short-term liabilities, a written promise to pay a specified amount on a definite future date with 1 year or within 1 year, or the company's operating cycle, whichever is longer. So they give you an example here of a notes payable. The reason why it's a notes payable, it used to be an accounts payable. They converted it to a notes payable to extend. On August 23rd, Brady Company asked McGraw to accept $100 cash and a 60-day 12% $500 note to replace its existing $600 cash accounts payable. So all they did here was obviously debited accounts payable to take out that $600, right? They show as a credit that $100 for that debt was paid, and then the rest was put on a notes payable. It doesn't matter about the discount. It doesn't matter about the due date. We're just showing that it has been converted. Note given to extend credit period. Yet again, on October 22nd, Brady pays the notes plus interest. Now, before they owed $500, right? Now it's time to pay the note, so they have to record the principal plus interest as of the date that it was paid. So $500 was the principal amount times the 12% interest rate, which means that it earned an interest of $10, and then multiplied by 60 over 360. Why do we do 60 over 360? It was only a 60-day note, and it's 360 days within a year. Everybody understands that, right? This is just showing you an example of a promissory note. They don't necessarily look like this anymore. It's just, you know, a document, but that's what they used to look like. So if a company borrows money from the bank, generally is considered a notes payable. In this case, the company borrowed $2,000 at a 12% interest rate for 6 days, right? So to show that the company received the money from the bank, it's just a debit to cash for that $2,000 and a credit to their notes payable, so that they know that is an obligation for the next 60 days of $2,000. Now, on November 29th, how many months after the initial 60 days, right? Notes payable for $2,000, but it has earned interest, right? 2,000 times the 12% interest rate times 60 days, because that's how long the note was for, divided by 360 days out of the year. Interest expense of $40. The amount of cash that they had to pay back was $2,040. End of period adjustment. Sometimes you have to adjust based on what? Not the period, but what happens between the time that the note is established. Interest, right? So when you pay back that note, you're paying the principal plus interest at maturity date. That's something that you need to always keep in your head, because we'll always deal with maturity rate going forward. Maturity date, I'm sorry, but maturity date is the date in which the principal is paid plus the interest. So you have to adjust for that. You can't just put the principal in there. So it says on December 16, 2013, a company borrows $2,000. It's the same $2,000 that we dealt with before, 12% interest rate, 60 days. This time, what they're doing here is, instead of waiting for the end of the, what date? What has happened? Instead of them waiting until, what was that date I just told you about? Maturity date. So until instead of waiting until the maturity date, they have decided to record interest 15 days in. Okay, so they've taken that 2,000, multiplied it by the interest rate, and then multiplied it by the 15 days over 360 to get interest rate of $10 as of the end of the year. Does that make sense? When the note was borrowed, or when the money was borrowed, was December 16th, 15 more days, December 31st, end of year adjusting for the fact that they have to do all of their reporting, right? They could only record $10 for interest expense. And then, of course, going into the next year, they have to include that interest that was sitting in the account from the previous year and the remaining interest by taking the principal amount of 2,000, multiplying that by the interest rate, and multiplying it by how many days were left out of the 60 days, 45 days over 360. That gave them a remaining interest expense of $30. So it still equals out to the 40, right? All they did was they adjusted for the fact that the loan was borrowed towards the end of the year, and they had to do year-end reporting. So they had to record the interest earned as of that date. So payroll. How many of you are taking payroll accounting right now? Nobody? How many of you have taken it already? How many of you have to take it? Plan to take it. 9 times out of 10, you might end up taking it with me. It is offered online. But payroll is not a hard thing to do. We all like money, right? You want to know how much money you're going to earn. So, payroll liabilities. The company incurs a payroll liability every time they do what? Well, every time they pay the people, right? So that's when they incur the liability. This is very important. I just need you to know what taxes employers pay and what taxes employees are responsible for. Okay? First, we need to distinguish what's the difference between gross pay and net pay. What is gross pay?
Gross is what you pay. Net is
What you made before taxes. Net is after taxes and deductions. So the taxes that we are concerned about, FIT or federal income tax, SIT or state and local income tax, voluntary deductions, your insurance, your pension, retirement, all that good stuff. FICA, Medicare, and FICA Social Security. I generally will call FICA Medicare OASDI and FICA Social Security. Let's see if they, I don't think they listed that way in your book. No, they don't. So let's go by what they have in the book. So FICA, Medicare, and FICA Social Security. Now, FICA taxes, this is both an employee and employer obligation, okay? Employees and employers pay the same rates. So for FICA Social Security, it's 6.2% on the first 110,100. Because this book is the old edition, that amount in actual life is different this year, okay? But just working with what we're using with this textbook, 110,100 is the limit or the max for FICA tax and Social Security. So before you get confused, what does this actually mean? It means if we calculated employees' pay and we are trying to find out FICA tax and Social Security, if that person had earned 112,100, we would not be eligible to tax them on FICA Social Security because they have passed the maximum amount of what? 110, 100. That's how that works, okay? FICA Medicare is always 1.45% on all wages. There is no max. So I don't care if they made 100,000, I don't care if they made 2,000. They're still eligible to be taxed 1.45% of all wages earned. Federal income tax, we all know this is going to vary. The reason why we're not getting into this in this particular book is because this is just introducing you to payroll. But when you get in payroll accounting, you'll notice that FIT is going to be different for every employee based on withholding, based on exemptions, okay? And what else? And actual rates. And then state and local income tax, that's generally given to you. That's not something that you'll have to actually break down. Now it says employers must pay the taxes withheld from employees' gross pay to the appropriate government agency. What that means is just because FICA, Social Security, and Medicare is matched by the employer, FIT is not. FIT is not matched by the employer, but the employer is required to take FIT out of the employee's check and send it to the Internal Revenue Service. Does that make sense? SIT, same situation. Voluntary deductions. Those are things like your retirement, your pension, your vacation, bonuses, insurance, health, whatever it is that you pay extra that is not considered to be a federal regulated tax is considered to be a voluntary deduction. So this is just giving you an example of what has been paid for an employee. Okay, this is accrued payroll for this particular month. They paid a total salaries expense of $2,000. FICA Social Security 6.2%. All they did was took the $2,000, multiplied that by 6.2%, got $124. FICA Medicare 1.45% on what? How many wages? Or all wages, right? $2,000. They gave them $29. FIT, that was just given $213. Medical insurance $85. Union dues $25, and the remainder was the actual what? What's this amount? What is it called? Net. That $2,000 was the gross. $1,524 was the net after all of those deductions. Payroll, I told you they were responsible employers to pay both FICA, Social Security, and Medicare, right? They're also required to pay what we like to call FUTA and SUTA. That is for the unemployment contribution. The reason why they have to contribute to that is because in the event that an employee becomes unemployed through their company, for whatever reason, it's the limit on that, stipulations on that. But if they become unemployed, they can go to their local state office and request to get those funds from, FUTA and SUTA that have been deducted and paid by the employer. So what are the rates for FUTA? 6.2% on what, max? First 7,000. What that means is if we're calculating somebody's pay and their year to date is already over 7,000, we cannot tax. We don't have to pay taxes on that employee for FUTA. Does that make sense? SUTA, same situation. It's on the first 7,000. Now, the most confusing thing about FUTA and SUTA, when they say here a credit up to 5.4% is given for SUTA paid, they are talking about on the employer side. Sometimes when an employer decides to contribute to FUTA throughout the year, they get what is called some type of credit or leniency. Because they paid ahead of time. They didn't wait until the end of the year to pay towards FUTA. They didn't wait until the end of the year to pay towards SUTA. So if we're going to record the employer's portion, they paid the same 6.2% rate and 1.45% rate for FICA, Social Security, and Medicare. They paid SUTA of 108. What was that? The 2,000 times the 5.4%, 108. Meaning that person didn't get up to what? What max? 7,000. And then FUTA, the 2,000 times the 6.2% minus 5.4% equals $16. And you won't have to get that technical when you start doing the homework problems. But that is normally how you go. Multi-period null liabilities. Remember how I explained those earlier. So they're talking about the example they give you, which is a good example. Magazine subscription. So you know how you pay max or base amount for magazine subscriptions, right? But do you get them right away? No. So 9 times out of 10, before the year's out, let's just say you subscribe in July. You won't get, but how many subscriptions before the year's out? 6 or 7, right? Give or take, depending on when the day was. But we'll just go with 6. So that means the company who gives out these magazine subscriptions, when they record not the company, you as the person or the company, when you record these magazine subscriptions, you're going to account for earn at what point? As the subscription is sent out. It's unearned when you first do the subscription because you've got money for magazines that you have not sent out yet. But until the magazine has actually been sent out, it has to stay in unearned, and as they go out, then you convert them from unearned to earned. Estimated. What's the estimated liability? How can that be estimated? Why would we want to estimate it? But I thought liabilities were just pretty straightforward. Why would we need to estimate one? We just talked about payroll. That's one of the main areas of estimation. What do we estimate? As not how much you made, but as an employer, what are some things that you have no control over? You won't have an actual amount until the event occurs.
They actually work. Like your healthcare.
The health insurance, right? Health insurance, vacation. I can't record that you took a vacation until you actually take one. I can't record that you use $500 in medical premiums until it actually occurs. So this is where we have to estimate. Notice how with health plans, generally they'll have a base amount that you pay every month, right? That's their estimate. You know how they give you a deductible to reach every single year? That's what they estimate you might potentially reach. You may go well beyond that. If some circumstance happens or occurs where you have a huge medical situation, then their estimate could be wrong. So it says employer expenses for pensions or medical, dental, life, and disability insurance. Assume an employer agrees to pay an amount for medical insurance equal to $8,000 and contribute an additional 10% of the employee's $120,000 gross salary to a retirement program. So this journal entry is showing you the $8,000 that they estimated and the retirement program payable of $12,000, which was the $120,000 times what? The 10%. That means the total employee benefit expense is going to be $20,000. That's how much the employee will end up paying towards that. Vacation. How do we calculate vacation? Assume an employee earns $20,800 per year and earns 2 weeks of paid vacation each year. All we need to do is take what they earn per year and break it down to what? Weeks. So that's also going to depend on what else?
Whether they take it.
I guess we got to say it a different way, but yes, it is, you know, they don't really care about whether they take it. You're going to get it regardless. So salary divided by is how many weeks in a year? 52, but we're giving them 2 weeks paid vacation. So we divide it by 50 weeks, which equals 416, right? That's assuming that they take the vacation. 20,800 divided by 52 weeks equals 400. That's if they did not take the vacation. So how much would we actually have to pay out every week for those 2 weeks? $16. Yes, that's low. That would never honestly be that way. That's just example. I know nobody is taking vacation and getting paid a $16 check every week. So vacation, the journal entry to record that is vacation expense, and this is just for 1 week. Benefits expense $16 and vacation benefits payable to be paid $16. Bonus plans. I need you to write this down because it's very important because a lot of students just don't understand it because it is incorporating math, going back to math. So, bonus. Sometimes employees get paid bonus plan every year, okay? And it can be a different amount or different percentage. Assume that a bonus will be paid to employees equal to 5% of the company's annual net income of $210,000. So this is the way every single time you have to calculate a bonus. There's no other way. This is the exact way that you need to do it. We know 5% or 0.05. When you have this in the parentheses, what's the rule? Do parentheses first. So 210,000 minus B, 10,500 minus 0.5 B. That's us doing what's in parentheses, are we not? Everybody clear so far with that? So then here, 10,500 minus 0.05 B, 1.05 B equals 10,500. We're just breaking it down even further. Next line, B equals 10,500 divided by 1.05. Bonus equals how much? 10,000. And we'll do a problem that will allow you to break that down. But I just want you to write that down because I don't want you to forget it.
And it's also on page 446.
What page? I'm sorry.
448.
Thank you. Also on page 448. So the journal entry to record the bonus that we've calculated up here is a debit to employee bonus expense, 10,000, a credit to bonus payable, meaning what we're going to have to pay as a bonus to employees, is 10,000. Everybody has this, or you still writing? Okay. You guys have it? You're good. Okay, warranty. This is also very important. What is a warranty liability? Perfect example, probably the only example, well, not only, but you get a warranty every time you purchase a car, right? Or at least you should. With the warranty, this is a just in case type of situation, meaning we will replace certain things on the car and they base it up until a certain amount of miles, possibly. So it says the seller's obligation to replace or correct a product or service that fails to perform as expected within that specified period. To comply with full disclosure and matching, the seller is going to report the warranty expense when? When the sale happens, right? So in other words, this example they're giving you, they sell a car, 16,000, 1 year or 12,000 mile warranty covering parts. Past experience indicates that warranty expenses average about 4% of a car's selling price. So if we're going to record the warranty expense, how are we going to calculate it?
Take the selling price and multiply by 4%.
16,000 multiplied by 4%, which should equal $640, right? That's the warranty expense. So this first journal entry is to record that expense. The second journal entry, it says that the customer returned the car for repairs and they replaced parts costing up to $200. So in this case, they just took 200 of that 640 and put it towards repairs, and then also subtracted $200 from the their auto parts inventory, because obviously they had to replace using their auto parts in their inventory. What is a contingent liability? And at this point, I'm on page 500 in your book. 450, sorry. What's a contingent liability?
It's a liability that depends on the likelihood of future.
So liability that depends on a future event developing from what? Something that has happened in the past. So if the future event is probable, possible, or remote, that has different kind of accounting methods for it. Probable meaning that it'll likely happen. Likely meaning, yeah, it'll happen. Possible means it can possibly happen, but it's not a definite like probable is. And remote means we don't expect it to happen at all. And if you don't expect something to happen, then you don't need to disclose anything, right? But if something is possibly going to happen, the amount that is owed, because it's possible, we have no idea what the amount would be, right? But we still need to disclose it in that event. And if it's probable, meaning that likely or it will happen, we can reasonably estimate that amount and we can record the liability and adjust for it later if it does not occur. Now, what happens with these, to break it down even further? Think about all of the doctors and the dentists and all the medical professionals that are out there that have these independent practices, right? It is probable that sometimes they can be sued for malpractice, right? Possible, meaning it could happen, but they don't expect it to. That's what they go into business thinking. Remote, there's probably no remote chance that, they won't be sued for malpractice, especially because going into an independent practice, that's one thing that you sign up for, the potential of having a malpractice claim. So if it does come through, if it's probable in a situation, then obviously we can estimate because the settlement or the offer amount may be put out there. If it's possible, but we don't expect it to happen, we can't estimate an amount. And obviously, if it doesn't happen at all, then there's nothing to do what? Nothing to disclose, nothing to tell, nothing to talk about, nothing to record, right? Okay. It is now 11 o'clock. So let's go ahead and go over these problems. I said 11-2 for
5 and 6.
5 and 6, okay. So for exercise 11-2, and we're on page 466, it says prepare any necessary adjusting entries at December 31st, 2013 for Piper's Company's year-end financial statements for each of the following separate transactions and events. The first transaction says Piper Company records an adjusting entry for $10 million of previously unrecorded cash sales costing $5 million, and its sales tax rate is 4%. So how are we gonna, before we can record the journal entry, we need to calculate what? The sales tax. So what's the sales tax percentage?
4%.
4% of cash sales. What's the cash sales? How much?
10,000.
What's the cash sales?
10 million.
10 million. It costs them 5 million, which we're gonna get to that point. But 10 million times 4% is how much?
400.
Equals 400,000. So what's the journal entry to record this transaction, the first transaction?
Debit cash.
Uh-huh.
10 million. Then you credit the sales.
Debit cash. Credit what?
Credit sales
Sales.
and sales tax payable.
So sales and sales tax payable. How much for sales tax payable?
400.
400,000. How much for sales?
5. 10.
10 million.
Okay.
How much for cash?
10.
10,400,000. Now, transaction 2 requires that it says the company earned 50,000 of 125,000. Oh, wait. We're not done with transaction 1. Anytime you record a sale, and you should remember this from financial accounting 1, but anytime you record a sale, you also have to record the what? Cost of that sale. So we're gonna debit what? We're recording the cost at this point. What did you sell?
Because that's where I just took that 5. I don't know.
What did they just told you cash sales, right?
Yeah.
So when you record the cost of sale, do you remember that account, the cost of goods sold?
Yeah.
That's what you need to debit. Cost of goods sold, and you would credit what? Whatever you sold. What would you have sold? Merchandise inventory. So debit to cost of goods sold for what amount? 5 million. She's been hollering at 5 million out this whole time. And credit to merchandise inventory for the same amount. Now we can move on to transaction 2. So transaction 2, the company earned $50,000 of $125,000 previously received in advance for services. So that's relatively easy. Obviously, when we received that 125,000, we recorded it in what account? Unearned revenue.
Yeah.
And so now we got to take it out of unearned revenue and put it where? Earned revenue, which means we got to debit what?
Okay.
No, unearned revenue and credit or revenue, doesn't matter. What's the amount? 50,000. All you earned was how much? How much did you say you earned?
50,000.
So we don't debit the, cash and then the, unearned ticket revenue
Why would you think you're gonna debit cash?
for $125,000.
You received it already. Y'all do get how unearned revenue works, right? Going back to the concert sale, they got that money up front. That's the part you have not recorded. They didn't ask you to record that. They asked you to record how much was earned at this point, assuming that the cash of 125,000 had already been received. Okay, so I don't want you to misread that. Normally, it probably would say record unearned revenue received or cash in advance received, and then also record that they received 50,000 of that 125,000. Okay, exercise 11-4. Sylvester Systems borrows 110,000 cash on May 15, 2013 by signing a 60-day 12% note. First, they want us to calculate what date does this note mature? Meaning, what date should it be paid?
Was it July the 15th?
One of them got 31 days.
So, how many days was the note?
60.
60 days.
Just get one.
What was the date of the note?
The date of the note was the 15th.
May 15th, I think.
May 15th
Yes.
plus 60 days.
July
July
15th.
15th or 14th?
14th.
Because it's 31 days in July, right? All right.
31 days in May.
31 in July too, right?
30.
We're not going all the way into July.
Oh, sure.
Yeah, talking about-
I don't know.
It's 31
I
days.
didn't want to get technical, that's why I just skipped
It's
the
31 days in
60.
both months, isn't it?
June and July.
Not June.
Not July, May and July.
So it'd be like Thursday?
That's what I said, but that was like we're gonna go through the whole July.
Say we're not using the entire July date.
In other words, if it had just been 30 days in May, then it would have been
July 15th.
May 30th, would have been 15 days past. June 30th would have been how many days?
30.
45 days. And then you would have went how many more days? 15, which means you would have done July 15th. But there are 31 days in there. So from May 15th to May 31st, how many days? 16 plus 30 more in June. Plus how many more to get to 60? More to 60. Miss you all, but we clear? Okay. All right. So 2. Suppose the face value of the note equals 110,000, the principal of the loan. Prepare the journal entries to record A, the issuance of the note, B, payment of the note at maturity. So the first journal entry to record the issuance of the note. What are we gonna debit? What are we gonna credit?
Debit
cash,
cash.
Okay.
and then credit note payable, both of them 10,000.
110.
Yes.
All right. B, we gotta record the payment of the note at maturity, which means we gotta calculate for interest. Let's do that off on the side somewhere. What was the principal of the loan? Principal amount?
110,000.
Principal equals, what was the interest rate?
12%.
12%. How many days?
90. 60.
60 over. What's the interest?
12%.
Calculate.
Oh, okay. I put 13,200.
Oh, that's too much. 60 divided by 360 days?
Oh, I ain't prepared.
I got 2,200.
Okay, so
So 2,200 is the amount of interest. So what's the journal entry? Debit what, credit what?
debit notes payable and interest expense, and you credit cash. My amount's so wrong.
Interest expense and notes payable, debit, cash, credit. What amount for interest expense? 2,200. Notes payable? Principal. That's the principal amount, right? Know where these amounts come from, 2,200 for interest. And what about total cash amount? 200.
Okay, so for that problem,
Mhm.
the days are divided and then multiplied by the interest.
Or the other way around.
So
It's easier for you to
12%.
take principal, multiply the interest rate, and then multiply it by 60 divided by 3.
Okay, because that's the rate that they got.
Right. And we do 60 over 360 simply because this is a short-term notes payable. Had it been long-term, you just would have been concerned about the amount of years. Okay? You wouldn't be concerned about how many days over 360 days a year. We'll give y'all a minute to write that down and then we'll move on to the next one. You guys ready now? Okay. Exercise 11-5. Keisha Company borrows 200,000 cash on November 1st, 2013 by signing a 90-day 9% note with a face value of 200,000. 1. On what date does this note mature? Assume that February 2013 has 28 days. So let's start there. It was 5.
Yeah.
So for the first one, maturity date, what was the date of the note?
November 1st,
See, 11/1 plus how many days?
90.
90 days. So that means the maturity date is going to equal what? Okay, so just before we go down this road, November had 30 days. November had 30 days. December had 31 days. January had 31 days. And February had 28 days. So So from November 1st to November 30th, how many days have passed?
30,
From November 30th to December 31st,
31.
61.
Yeah.
From December 31st to January 31st, how much? Count. 31 to January 30th would be how many days?
30.
Will be the full 90, right?
January 30th.
61.
January 30th.
But, okay.
I think
91
January
days.
29.
Since we doing November 1st, we would be
Yeah, January.
30 days instead of, 29 days, instead of 30.
Plus 31 days.
It's 31, that's it.
Plus how many days in January to get up to
31.
90?
30.
So you're gonna do
January
30 days.
30th,
So it's January 30th.
yes.
So you don't count the.
Don't count the day of. I'm gonna bring y'all the calendar. Okay? Cause you do need it. I need to give it that anyway. That's what I need to give you anyway. I always give classes that. So it's fine. It always gets confusing. Second one says, how much interest expense results from the note in 2013? Assume a 360-day year. How are we gonna calculate the interest for just 2013? What was the principal note? What was the amount of the principal? 200,000. What was the interest rate? How many days are we looking at by the end of 2013?
90 on 60.
At the end of 20.
59 days.
From November, thank you, from November 1st to December 31st, that would be a full 60 days, right? Fraction of a year, I know. Fraction of year, 60 days into 360. So that means 2013 interest is gonna be how much?
$2,000.
3,000. All right, 3 wants us to find what? How much interest for 2014? Same situation, principal,
And it's gonna be 30 days you got?
30 days, because that's how many are what?
Left.
Left. 200,000 times that 9% interest rate. What is that? Fraction of year is 30 days over that 360. What's the amount of interest for 2014?
15,000. I mean, 15.
I was gonna say if you got 15,000, something's wrong with that calculator. All right, 1,500. Now, number 4 says prepare journal entries to record A, the issuance of the note, B, the interest at the end of 2013, and C, the payment of the note at maturity. So A, the issuance of the note, what do we debit, what do we credit?
Debit cash, credit note payable.
Debit cash, credit notes payable. What's the amount?
200,000.
200,000. B, we need to record the first interest payment. Debit to interest expense, credit to what?
Interest payable.
Note payable.
Because this is just interest.
Oh,
Interest expense,
interest
interest payable. Payable, how much?
3,000.
3,000. And then C, we need to record the note at maturity.
They're gonna need interest expense for the 30 days and interest payable for the 60 days.
Interest expense for 2014, interest expense for 2013, well, interest payable for 2013. And what else?
Notes payable, and then cash.
So, interest expense 2014, how much? 2014,
Oh,
1,500. Interest payable,
3,000.
and we know that was 2013, 3,000. Notes payable,
200,000.
200,000, which is what? Principal.
Yeah.
And then credit what?
That's
How much?
the total amount.
200,
200,000.
204,500.
All right, on to the creme de la creme and the final problem of the day. So that you can go home, because I can tell you're tired, judging by the yarning and
Long weekend of alcohol.
long weekend of everything. No matter what it was. Y'all are tired. And I did good to keep you awake this long. Alright, so do y'all have this?
Not yet.
Okay. I'm just gonna read 11-6. BMX company has one employee. FICA Social Security taxes are 6.2% of the first 110,100 paid to its employee, and FICA Medicare taxes are 1.45% of gross pay. For BMX, its FUTA taxes are 0.8%, and SUTA tax 2.9% of the first 7,000 paid to its employees. Compute BMX's amount for each of these four taxes as applied to the employee's gross earnings for September under each of the three separate situations. So they got A, B, and C, right? Just so that you know what it is that you are reading. In that little grid, the column where it says gross pay through August, that is considered to be their year to date. Okay, for that one employee, under those three separate assumptions. And then under the column where it says gross pay for September, that's that current paycheck. Okay, for those three separate assumptions. So, y'all have this?
Yeah.
Okay. Since we got three separate assumptions, the first thing we're trying to find is how much of that paycheck is subject to tax. Second thing is the rate that needs to be applied and the actual amount of tax. So, three columns. Tax rate and amount of tax, okay? And for A, how many taxes are we calculating here? How many different taxes?
Well, for the first one, it'll be 1, 2, 3, 4.
Four. FICA Social Security, FICA Medicare,
Yeah, not Medicare, and then
FUTA, and SUTA.
If I thought Susan was only for the first
We still gotta list it. FICA. FICA, Med, FUTA, SUTA. Because when you see it on your homework, it's gonna all be listed out. So you need to know what to do. How much for A? The current paycheck is $800. The year-to-date for A is 6,400. So how much of that 800 is subject to FICA Social Security? All of it. Why?
Under 6, 7, yeah.
It's under what? No, 7,000 ain't got nothing to do with it.
Under.
110,000. We're talking about FICA Social Security. The year-to-date is how much? 6,400. That's nowhere near 110,100, right? So the full 800 is subject to tax. What's the rate that we use? 6.2%. What's the actual amount of tax? 800 times that 6.2%.
$4
$49
Oh, $49.60.
Okay. FICA Medicare. How much of that 800 is taxable?
All of
The
it.
whole thing.
All of it. What's the tax rate?
1.35,
1.45%, which means the actual amount of tax is how much?
$11.60.
$11.60. Now, FUTA, what's the max?
7,000.
7,000. And what's that person's year to date right now?
64.
6,400. That's pretty close to 7,000, right?
Yeah.
So how are we going to determine how much is taxable?
Don't we add the 8,
Add. You do know. Max is 7,000. Right now they're at 6,400. How do you find out how much is taxable of that pay, current pay?
You gonna multiply it by
Multiply. Subtract the 6,400 from the 7,000. That gives us how much? 600. So that also means that how much is taxable for FUTA? 600. How much is taxable for SUTA?
600.
And just so the people online know what we did. 7,000 minus 6,400 equals 600 taxable. All right, so what's the rate for FUTA?
FUTA is 0.8.
0.8. That's important, okay? That you know it's 0.8 and not 8%. So what's the actual amount of FUTA tax?
$4.80.
$4.80. And what about SUTA? What's the rate?
The rate for FUTA is
2.9%.
So 2.9%, which means that SUTA, $600 times 2.9% gives us how much for SUTA?
$17.40.
Say it again.
$17.40.
All right. Now, assumption B. Same taxes, right? FICA Social Security, FICA Medicare, FUTA, SUTA. How much? Assumption B, the year to date is 18,200. The current paycheck is 2,100. How much of that 2,100 is taxable under FICA Social Security?
all of it,
All of it. Why?
because it's under 100.
The year to date is not up to 110,100, right? So 2,100 times what rate?
2.2.
How much for tax?
$130. I mean, $13.
$13.
$130.
All right. FICA Medicare, how much is taxable?
The whole thing.
2,100. What's the rate?
1.45%.
1.45%. What's the amount of tax?
$30.45.
Are they eligible for FUTA? What's the year to date?
1,800.
No.
1,800 or 18,000? So no, they're not eligible for FUTA or SUTA, right? Because what's the max?
7,000.
Good. What's assumption C? How much is the current paycheck?
8,000.
8,000 is the current paycheck, and the year-to-date is 103,800. Same taxes, FICA, Social Security. FICA, Medicare, FUTA, and SUTA. How much is taxable under FICA, Social Security?
102,000.
What?
I'm sorry, I said that wrong.
8,000.
That whole 8,000 ain't taxable.
No,
What's the max?
7,000.
No.
I mean,
It's
110,000.
110,100. And what's their year-to-date?
It's higher.
So it's the same
Subtract.
assumption, is it not?
Yes.
110, 100 minus 103. What is it, just 103?
103, 103,000.
103 what?
800.
800.
How much is left?
6,200.
So how much is taxable under FICA, Social Security? 6,200 or 6,300?
62.
Calculate it again.
Oh, you said, I got my number wrong. You said it's
It's 63.
110,100.
It's 6,300. 6,300 is taxable under Social Security FICA at 6.2%. What's the actual amount of tax?
$390.
$390.60. How much is taxable under Medicare?
The whole thing.
Which is
8,000.
8,000. 1.45% is the rate. The amount of tax is how much?
$160.
116 even. Are they eligible for FUTA? SUTA? Good. Somebody, does anybody have their course schedule?